Welcome to the Deal Flow Collective Microtribe call. Today is February the 18th. I'm very excited and happy to introduce Christine Valdes as the speaker today. So I first met Christine about a year ago in Costa Rica. So as a relatively newer member, I just thought she was so friendly. She came over at a cocktail reception and introduced herself, so I immediately felt really welcomed. And I learned that she is a super kick-ass sales leader in the pharmaceutical industry, right? So, I mean, I've watched a couple of movies like that, so I know what kind of character she could be to kind of have accomplished that kind of career accolades in her field. And then I learned that she is also a very experienced real estate investor, both actively and passively as a GP and LP in different syndications and funds. So over time, got to know her. She and I got to be roommates in the Austin event last fall. So we had, quite a few nights of good talks and good laughs. So yeah, I just thought she's a, superwoman who can do it all. I knew I wanted to be her friend, and I knew that, one day if I, were so lucky, we would get to work together. So yeah, so happy to present to you, Christine.
Thank you, Alice. That's such a nice introduction. Oh, I feel teary. I guess what I'll do is I'll put my slides up and then I'll start talking. So I have a couple of notes so that I don't miss anything. So let me see which one I'm supposed to share. Okay, can you guys see that? No? Yes? Can you
Yes.
see that? Okay. So I will slideshow it. Okay. All right. Does that work? Everybody sees that? Yes?
Yes.
Okay, perfect. So hi everyone. Like Alice said, I'm Christine Valdes. I'm oh, it's moving, isn't it? Why is it moving on its own?
Yeah, because it's in slide mode, so you can
Oh,
pause
okay.
that. Yeah.
I'll stop it then. View. Exit full screen. Okay, that's it. Okay, that's
No worries.
better.
Yep.
Okay. I didn't know it starts to move on its own. So as you guys know, I'm really excited to be here. It's actually my first presentation to Go Abundance Women, so I'm a little nervous, but I'm very excited. I don't know if you guys know, I've been in Go Abundance almost 4 years now. I was actually shocked when I when I realized that it's almost 4 years. So I've been around a long time and I've watched the community grow and I've seen incredible women step into the community. So I witnessed the power of connection and what that does for all of us. And so I continue to be here because I believe that it's just a great organization that lifts all of us up, not only professionally, but health-wise, personally, et cetera. So I'm happy to get to be here. I think I've met most of you, I think on the call, except for one person. So I think most of you I've met in person. So hello again. But just to give you a little bit about my background, I've spent the last 27 years in the pharmaceutical industry, 20 of those in sales leadership roles. I've managed teams of over 200 people and businesses over $200 million annually. So I have a lot of experience in the pharmaceutical industry, working in small pharmaceutical as well as medical device and capital equipment. So I've spent my whole career there, but I realized that the pace was with which I was going at 90 hours a week made me realize that I needed to build additional income streams and a path forward towards financial freedom. I just couldn't keep up the travel of 175,000 miles of domestic flying per year on top of my 90-hour work week. So it wasn't just a personal realization of this, but it was also ingrained in me. My parents actually were immigrants here to the United States many, many years ago. I came with them when I was one, and they had W-2 jobs, and they also owned a small business and also some small multifamilies. So I got to see firsthand, not only them juggling their work, but also trying to do a business and real estate. So my parents actually got into small business in the 1980s. They bought a bunch of laundromats. Back then, the laundromats weren't the set it and forget it business model where, you can just log in and somebody would open it for you. back then it was where my dad would work all day, and then in the evenings he would go to the laundromats, he would collect all the coins, he would refill all of the detergent and the dryer sheet machines. He would refill the dollar machine so that it gave change. He would fix all the washer and dryers himself. He would clean up the laundromats, and then he would close the laundromats every evening between 11:45 and 12 midnight. So he did that every single day. And then I would see my dad and my mom on the weekends and sometimes weeknights if needed, fix garbage disposals, fix, toilets. We had all the equipment to fix plumbing. And then if an apartment was vacated, I would help my parents clean up the apartments and paint and all of that. So I saw the application process, everything that my parents did on their own. They didn't have someone manage it. So I watched my parents juggle the ups and downs and the relentless work ethic that they did. They poured into giving a better life to myself and my five siblings. So that early exposure to real estate, I think, really put an impression on me. So in 2001, I flipped my first house. I actually did a house hack in the Bay Area. I lived in Oakland and I bought a house in the I guess it's not the Oakland Hills, it's just below. It's like the hills, but below the flats. If you guys know Oakland at all, there's like the flats and the hills. And I bought a fixer and I house hacked it, and I actually did really well. I actually made $300,000 on that flip, which is amazing for a first time flipper, right? But at that point in time, I don't think I really wanted to dive into real estate, even though I had a huge profit on that first flip. I didn't really jump into real estate until later. I actually did get my real estate license too, but my career was taking off in pharmaceuticals, and I felt like I needed to really focus on that. I also met my husband at that time, so I was in love, and so decided to get married, right? So I had my daughter and my new husband. But since then, my husband and I have actually built a portfolio of single family homes in California and in Texas. We've flipped multiple properties over the last couple of years, and we've invested in multifamily units, both as a GP and an LP in Texas and Arizona. I did quickly realize that as I did more flips over the last couple of years that I don't like flipping. I really hate flipping. I'm not a designer. If you look at my house, all my walls, except for this one wall, has no pictures on it. So I'm really not into designing or picking the right granite countertops or anything like that. But I was good with negotiating with wholesalers, right? But I didn't like cold calling homeowners. I didn't like putting my postcards together. I didn't like pulling the lists. I didn't like having to do the skip tracing. I didn't like having to do all the marketing because I was trying to find, off-market houses to flip. And for me, the ROI wasn't worth my time. I felt that instead of gaining financial freedom, I got a second job. Right. And that's what I didn't want. Right. A lot of us want to do this passive investing so we don't do a second job. So my husband and I moved into multifamily. We thought, okay, this is going to have cash flow. We're going to have depreciation benefits for our high W-2 earnings. We're going to have long-term wealth building. And when we jumped in, to be quite honest, we jumped in the heyday of multifamily. It was like that 2021. People were turning their multifamilies in 2 or 3 years, and they were making a lot of profit. And we thought, okay, maybe this is the where we need to be. But as interest rates rose, cap rates compressed, we saw our returns shrink. And it became more time consuming than we had anticipated. So managing properties, dealing with tenant turnover, that's been a little difficult in the Houston area. And the wait times were longer than I wanted, right? Because I'm not going to work. I probably have a little bit of a runway of working still, but it's not long. My runway isn't super long. So though we have the multifamilies, we didn't know if that was going to be the right fit for us long term. And then so over the last, I would say, 14 months, I started looking at other opportunities that maybe would be better for us. We actually bought a digital marketing business. Again, it's a third job for me. So like, okay, honey, you're going to do the digital marketing. I cannot do that. But we wanted to trying to find something that was truly passive with high returns, shorter hold times, and no tenant headaches. So I searched. I looked at the ATM machine funds, right? Those are a little risky due to digital payments increasing and operational changes. I looked at logistic funds. There was a couple of funds for logistic companies out there. I don't know anything about logistics, but what I found out was that it's really highly fragmented. So to put money in a logistic company, because it's fragmented, it's hard to really manage all of that unless you're a really big player. I looked at general private equity, right? While the returns looked good, the hold times were really long. So some of them are like 10 years, and I didn't want my money's already locked up in a lot of multifamily for 5 to 7. So that's when I found Pender Hastings and the opportunity with Alice and her group. What I liked about it is that it bridged the gap between my passion for real estate, because I still really do love real estate. I just don't like flipping. And my need for truly passive, high yield investments. So shorter hold times, higher returns, lower volatility, and no tenants, toilets, or turnover. So I was really looking for something like that. And I also knew that's the reason why I'm talking to you guys today was that there are a lot of other busy professionals like myself who want to invest in real estate, but they don't want to do the flipping. They don't want to have to manage the properties. They don't have the time. And they also wanted something better than a 7 to 8% return. I started doing an analysis of my stock portfolio. And after I paid my broker, I was making 4%. So that wasn't going to cut it for me to really grow my wealth. So this actually really fit what I was looking for. So let me just give you a little bit about our thesis, and I'm just going to move it this way if you guys can see everything rather than putting it in the slideshow view. Um, but as you can see here, this is just a picture of where we are with the housing crisis. You'll see that in 2006, 2000 and between 2006, 2007, we were at our heyday. We were producing about 2 million homes per year, right, at this point. And then we had the Great Depression, and not direct depression, but we had the dive and the housing crisis that occurred. And so this blue line represents the number of home completions. And you can see we were at our lowest in about 2012, producing about 500,000 homes per year. And we've slowly increased since then. 2003, we're at about 1.1 million homes. But you'll see here that the demand for homes continues to increase and outpace the number of homes that we're building. So right now we're building 1 million to 1.1 million homes per year, but the demand is relatively around 1.5 to 1.6 million. And this is due to new families being formed, people moving, migration, millennials now are in the home buying age. They're ready to buy homes, and that's the biggest generation right now. And behind them, we have the Gen Zs. So this black line right here, this is going to continue to increase. And we just can't build enough homes fast enough to meet the demands. So that's really a high opportunity for us, right? So what we do is we decided to step into land development, and particularly land entitlement and horizontal land development. Sometimes when we talk about land development, we talk about land banking, where we buy land and you hold it and you sell it. This is not what this is. This is actually investing in operators who do land entitlement and land investment. So I'll go into that in a little bit. But just to let you know, here's some of our home builders in the country. The largest home builder is actually D.R. Horton. In 2023, they built around 90,000 homes, and they're expected to build more over the next 4 years. Lennar is the second largest home builder, the Pulte Group, and then so on and so on. And then if I pull this chart here, you'll see the numbers, right? So you're looking at land development, and we're talking about land entitlement, um, and horizontal land development, and why this is such valuable investment opportunities. Well, if you look at home builders, they build homes, but they don't necessarily do land entitlement or horizontal land development. While some do it, the majority, especially publicly traded builders, they're moving towards this land light model. And this means they don't want the land sitting on their books because it impacts their financial ratios and their stock performance and their quarterly earnings. So what they typically do is they outsource the land development. They have other companies do it, and those are the operators we work with. So there's operators that do land development and do horizontal development. And what the builders do is they come in and they actually purchase those finished lots. And then they build the homes and they sell the homes. They do what they do well, which is building homes. Um, and so this creates a high demand and a low supply niche. And we're sitting in the sweet spot in this investment opportunity because we're working with those operators who are doing the land development and the horizontal, well, the land entitlement and the horizontal land development. So let me go into what that is before I jump into all the specifics. So land entitlement is where operators secure the zoning approvals, the environmental studies, and the infrastructure planning, making the land ready for development. Okay. Land servicing, also called horizontal land development, involves the installing of roads, the excavation, the utilities, water, sewage, and other necessary infrastructure, right? So there's two parts to it. So in the land entitlement process, the first step is taking that raw land, that's unapproved land, and making it fully zoned, engineered, and ready for home building. So this is the critical phase because without entitlements, a developer can't legally build homes on the site. So how it works is that our operators, our operating partners work closely with home builders, and they identify high potential sites based on the market demand and growth trends. So they look at the sites, they work with the home builders. They do due diligence on those locations. So they spend a couple $100,000 a year on data, and they're looking at they're conducting evaluations, doing topographic surveys, they're doing impact assessments, zoning reviews. They're looking at what's going to happen to that area in 6, 12, 18, and 24 months. Is it a viable place to do land entitlement or, horizontal land development? And then they collaborate with local governments and stakeholders to secure a necessary rezoning and infrastructure planning. A lot of the partners that we work with in this fund, they've been in the business 20 to 25 years. So they have really great relationships with the local governments and the stakeholders in those areas to really push through all of this zoning and legal approvals. And then what they do is they enter the engineering and design phase that involves stormwater management, wetland delineation, water and sewer infrastructure and road planning, and then everything required to prepare the site for development. And then they've finalized the shovel-ready land. So at this point, once they've done all of that, it's legal and it's zoned, it's now a fully entitled land. Now, sometimes people say, okay, so are we giving them the money and then they're buying it and hoping that the builder buys it from them? Well, we're not actually doing that. So what we're doing is that what the operators do is that what they're doing is they're securing a forward purchase agreement with a national home builder, usually a top 50, or a regional home builder, usually a top 20, before we even begin development. So our operators already have that A counterparty contract in place, and they lock that contract with the builder. So the builder, it's already defined in the purchase contract. They have the purchase price of the finished lots, including an annual price escalation to hedge against inflation. And then the builder provides an earnest money deposit to the land entitlement operator that we're working with, or the horizontal land development company that we're working with. They give a 10 to 20% earnest money deposit for the finished lot value. And then the funds are released into the capital stack. And then that ensures that the builders have skin in the game, right? So we already have, before our operators purchase the land, we already have a contract in place with the builder. Also, what we do to mitigate some risk is our partners also have a secondary and tertiary builders that want to purchase the land just in case that first builder decides to pull out of the process. So we already have other builders that are ready to buy. Right. So we already have a structured in that contract. There's a structured takedown schedule as well, defining how many lots the builder must purchase at regular intervals. So that secures a consistent revenue flow for us as well. So that's how we mitigate risk on that end. We're not putting we're making sure that there's already a contract in place before the land is bought. So we know that it's going to be sold. Does that make sense to everybody? Yes? Okay. And then when we look at land development, again, that's when we put in that's when the entitled land is done and we're now breaking ground, we're clearing trees, we're leveling the site, we're excavating the dirt, we're installing the essential infrastructure like water, sewer, storm drainage systems, power, gas, electricity, curbs, street signs, lighting, right? So sometimes when you see a new development built, if you guys have seen it, you'll see that it's just dirt for a while and you see a bunch of trucks there. And then after you see the roads being built and then all the plots. And so when all those plots are done, then the builders come in and they do those purchases and they start to do the takedowns of those plots, 50, 75 at a time. All right. So that's in a nutshell what we do is our fund. Our fund is actually you know, we're working with these operators. We have relationships already negotiated plans with these operators where we're funding a portion of this land entitlement or horizontal development. They're working with the builders, and then that's why it's so quick because the builders already have the contracts and are taking down these lots pretty quickly. And so you're probably wondering um, where do we develop? Um, we actually develop in, this data highlights right here the top five most, the top graph actually looks at percentage of population growth, positive and negative, and then the bottom graph shows the absolute numbers. So we're actually involved with operators that work in these areas, Florida, Texas, Georgia, South Carolina, Tennessee. These are the top five fastest growing states, both by percentage growth and absolute population growth. Um, in Texas, they're pretty, we actually talked to one of our operators the other day, and they're pretty bullish in Texas, in these key regions because Texas is, again, one of the most resilient housing markets with strong in-migration and business-friendly policies. North and South Carolina, there's rapid job growth in Charlotte, Raleigh, and Charleston. We have Nashville that continues to be a major growth hub. We have Florida. While some markets have seen some oversupply, our partners are focused on in Tampa, Orlando, the Panhandle, that Space Coast down to West Palm Beach, right? Which are poised to have long-term expansion. And then there's a secondary market, which isn't listed here, but they found in their data, again, they're doing hundreds of thousands of dollars worth of data, the secondary market where they've identified a unique supply-demand imbalance in Kentucky, which is interesting. So builders are eager to expand there and they're looking, and there are limited development partners in land development there. So we're targeting these high growth areas for our fund. And I think, the thesis looks pretty good. So just to take you through, and I'm talking really fast. I know I'm talking fast, but I wanted to walk through the investment details. I think that's probably where you guys are at now. So the project timeline is a targeted duration of 24 to 30 months. I love that because it's less than 3 years. So my money doesn't get tied up for such a long time. The preferred return is 12%. Investors get paid before GPs get paid. The profit sharing is with the GP's Class A, which is 500,000. It's a 60-40. After preferred return, Class B 100,000, 50-50 after preferred return. The annual targeted return is 25 to 30%, and this is with very conservative underwriting to over deliver on the expectations. So I think to me, this looked really fantastic for me because that's a really good return for me. And then the projected LP equity multiple is 1.5 to 1.6. And the distribution timing is 30 to 36 months after the project exit. So as when we do the funds, the first fund right now is a $15 million raise. We'll invest in 6 to 7 different operators. we at on this fund, we're actually doing our due diligence. We have an 8-page due diligence process where we look at each project that's presented to us by our operating partners, and we're doing our due diligence on top of their due diligence before we invest in their project. And so once we invest in the project, this distribution is based on the exits of those projects. So there's several projects within each fund. And then I think that's all of the information on it. I'm just making sure I have everything. So I guess the final thing is these are small niche funds. There's not a lot of people in this market right now. I think this is a really good opportunity. I think long term, there's still demand in housing. I think we've been able to show that. And the areas that we're looking at are really high growth areas. Um, and we're hoping that this is a really good fit for those of you looking for alternative investments in your portfolio.